do the usual here. I'm going to talk about the crop insurance changes. Randy will talk about the markets. There are not a lot of crop insurance changes, so this will be fairly quick. Starting with this, just some reminders. If you go to the crop insurance tab of our website, martinsonag.com, we put a lot of information out there, plant date maps, harvest prices, PP information, whatever is coming up. And then we have an FYI tab. Below that is presentations and all the summaries of our USDA reports. So again, another place you can go find what we've been talking about. We also do have a YouTube channel. That's how we publish all of our videos. So if you want to look at something farther back or you can't find it on the app, check out our YouTube page. And two, we have our mobile app. Okay, this is where I usually start with this presentation. We start tracking our projected prices on Monday, since we'll be in February. This is where we were sitting as of the close today. We had December corn at 464, which is right in line with where we were a year ago at 466. Soybeans today closed at 1054 for November. That's about $1 lower than we were last year. Spring wheat at the moment, September of 25 closed at 647 today. So we're down, but we're not down a huge amount on that. Also, flax has been added to this list. Flax will now have a revenue option. The flax price will be based off of the ICE canola oil market. And then again, we just got these harvest prices for the beans and the peas on January 15th. Those are where we sat there. We won't know the projected prices until March. We have no way to track those or estimate them ahead of time. Same thing with the dry peas. Just some really quick things to go through here. There were no crop expansions for North Dakota this year. Minnesota, we did add canola for some of the counties around here, including Clay, Becker, Ottertail. Added dry beans in one county. And in South Dakota, they added canola in a couple counties and soybeans in a couple counties. They did make some date changes to canola. For the counties in blue, the final planting date changed from May 15th to May 25th. And that in turn, of course, pushed the late planting period ending date farther out. This group of counties in blue, final planting date changed from May 25th to June 1st. And on the ones in the southeast corner, May 20th to May 25th for the final planting date. Minnesota, one little change. They changed your initial planting date by one whole day from 4/16 to 4/15. And that was it for the date changes. Enterprise units, nothing has changed here, except we do have separate enterprise units for organic, non-organic, really not an issue with any of our customers. And again, this is just a review. Nothing else has changed on this. Remember, we do have the multi-county enterprise unit. The counties to use that have to be contiguous, have to be in the same state. Your main primary county must qualify for enterprise on its own, and the second county must not. You can only have one section planted in that second county to get that multi-county discount. And what you're getting there is your little county that would normally be a basic unit is going to get the same enterprise discount as your big county, so it'll be cheaper premium. The flip side of that, of course, is those two counties will be thrown together for loss purposes. And you can, pick and choose those. You can do it for soybeans, but not for corn. It's just on a crop and county basis. RMA did a couple years ago add enterprise by type. That is available on dry beans, dry peas, sunflowers, and wheat. And you can kind of mix and match, for dry beans. You could have one type of dry beans could be an enterprise unit, another one could be a basic unit. What you have to remember here is you cannot do enterprise by type and then try to further subdivide it by enterprise by irrigation practice. Also, if you're doing the multi-county enterprise unit, once you tie those two counties together for the multi-county enterprise, you cannot do enterprise by type. Prevent plant reminders, again here, nothing's changed. We don't need two crop history anymore. So now the new rule is you can call the PP whatever your intent was. And we all quickly figured out we intended to do corn on everything. Now, the caveat there to remember though is the PP in that unit still has to qualify under the 2020 rule. So in my example of that 200-acre field, if you planted 190 acres of soybeans, we can't call that less 10 PP corn. We're going to have to call that PP soybeans because the 10 acres is not 20% of the unit. Also, again, no change. RMA liberalized this a few years ago. You can now plant a cover crop. You can hay it, graze it, cut it for silage at any time. No reduction to your PP payment. You cannot harvest it for grain or seed. And then again, remember, RMA has been very clear that you cannot call corn a cover crop. This is new this year. Of course, once you have one crop in a county that hits $200,000 for a claim, then RMA can do the review. They review the first year. If everything matches, we stop. If there's discrepancies there, they can go back 2 more years. RMA does have an exempt list. So just because you hit the 200,000 doesn't necessarily mean that you will have the review done. Unfortunately, they made this worse this year. New rule for 2025. Now they're going to add up all types of losses for, let's say, corn. So your PP loss, your harvested loss, any unharvested losses, plus any SCO, CEO, margin protection. They're going to add all that up. When that hits $200,000, they can review the claim. And all claims will be reviewed, which is going to get kind of messy because by the time the SCO, ECO claims are settled, months and months have gone by. It's a lot of work to go back and try to do those reviews. Not sure why they changed the rule on that, but just be aware that's out there. Another claim related thing I wanted to hit on, all of our companies can do direct deposit. So you can have your claim check directly sent to your bank account. This fall was, especially as we got closer to Christmas, we saw checks checks we were sending from our office in Fargo out to you guys getting delayed, getting lost. I even sent one priority mail to northern Minnesota and it ended up in, I think, Illinois or Indiana or someplace. So if you want to get your checks sooner, ask your agent at sales closing if you want to get set up for direct deposit or later than that. The rule used to be if you had your lender listed as an assignee, you couldn't do direct deposit. And they've changed that rule now that if the lender signs off every time for every claim payment as they happen, they can still be sent electronically. So again, if you're sick of waiting for checks, let us know. We can get you set up for that. This was one of the big changes this year. RMA actually simplified the new breaking in native sod. We have a new definition of new breaking. That is acreage which has not been planted and harvested or insured within the 4 previous crop years. That was 3 a year ago. Now they've pushed that to 4 years. We used to have all these rules about, some of this, the new breaking in native sod, the insurance companies could approve, some RMA had to approve. And I think RMA got buried in these requests and they decided to quit accepting them basically. So now instead of having to do anything at sales closing, instead of having to do like this formal written agreement request to RMA. New rules, whether it's new breaking or native sod, it is insurable the first year if 75% or more of your acreage is soil types 1, 2, 3, or 4 off that NRCS web soil survey map. Those have to be submitted with the acreage report by July 15th. And if your field makes your soil types qualify, that is insurable. If they're not, it won't be insurable until the next year. If you don't want to insure it, you can just not turn, you need to still tell us it's native sod or new breaking, but if you don't want to insure it, if we just don't submit the documents, it will not be insurable that year. So for new breaking, and again, new breaking is land we can prove has been tilled before. We have to have proof it was tilled on or before February of 2014, which is a strange date, but that was a date a farm bill was signed. So new breaking, previously cropped, gets 85% of the county yield, just that first year. The second year is just normal APH rules, no PP on that the first year. And if it's less than 5% of the unit, we just throw it in. We don't even mark it as new breaking. And that just gets the regular APH. Land coming out of CRP, they just tweak this a little bit. Acreage that has not been planted in 3 of the last 4 most recent crop years to comply with other USDA programs like CRP, that is not considered new breaking. But when that CRP comes back into crop rotation, you have to plant it within the first 2 years after it is out of CRP, or you will have to go follow the new breaking rules. And then for native sod, these native sod rules only apply, to these states up here: Iowa, Minnesota, Montana, Nebraska, North Dakota, South Dakota. Nothing has changed here. Basically, you will be in native sod status the first 4 years you plant an insured crop on those acres. It has to be coverage above CAT, or it takes 10 years after the first tillage to get out of that native sod status. Also, we have to track that across all crops and across years. And once we hit 5 acres overall of native sod, then these rules kick in and the penalties kick in. So for those, until you have those 4 years of an insured crop, your guarantee is going to be 65% of the county yield. They're going to take away 50 percentage points of the subsidy. And you have to report production, but they're actually not going to use it until those 4 years are up. Quality loss option. This is not new, but we had a lot of wheat claims with quality issues this fall. So just a reminder, if you don't have this on your policy yet, you're going to want to take a look at it this year. What that does is it looks at both the production before the quality discounts were applied and after, and you will be able to get the higher of those 2 yields to be part of your APH guarantee. Just like any other option, have to have it on your policy by March 15th. And then we do have until the production reporting date of April 29th to opt out on any specific database. So on a production worksheet, that column, the first red circle, that's your production before any quality factors are determined. And then you take it times the quality factors to get your production account on the right. That's what the claim will be based on, is the production on the right, but your APH can use the higher production before the quality. And here's an example of that. The yield before the quality deductions we're taking was a 48. It got knocked down to a 44. The 48 is what your claim was based on. or I'm sorry, the 44 is what your claim was based on. The 48 is part of what we use to determine your approved APH. And that 44 is used in determining the rate yield. And that's how all these options work. We have a rate yield before any of this, yield adjustment, trend adjustment, quality loss, all of those. The rate's based on before we apply all those factors, and your guarantee's based on the yield at the end of that. We have some new FSA programs, USDA programs that are coming out. We could be getting some questions on those. There's two different things going on here. One is the economic assistance. That has to be distributed by March 21st. I think it was 90 days since the signing of the bill, which will be interesting because we do not have an ag secretary yet. Brooke Rollins has gone through the hearings, but she has not had a vote yet on that. For this $10 billion in funding, though, we're going to have per acre payments based on what you certified at FSA for 2024. And the language of the bill said it can be grazing, haying, silage, whatever. That still will be counted. PP acres will be paid at 50%. We do have the normal payment limits. For some reason, they are saying average gross income instead of adjusted gross income this time. I'm not sure why they did that. We don't know what these per acre payments are going to be exactly. This is kind of what we've been seeing for estimates, and quite a few different groups have come out with some estimates on that. So corn, $43.80 an acre, soybeans, $30.61 an acre, wheat, $31.80. Oats, for some reason, $78.42 an acre. I can't explain that one. If you had oats that you certified as oats for hay, you still get that $78 payment if it was that's how it was reported at FSA. The other bigger program is the $20.78 billion in funding in that bill that was signed at the end of the year. This is for calendar year 23 and 24. You have to have a qualifying loss, and there's a long list of, it could be the drought, excess moisture, all that stuff. This one, the Trump administration will have to write the rules on this. And again, we don't have an ag secretary yet, so those will be coming. We have no other details of how this one's going to work. As soon as we know, we will pass that along to you. Stay with the FSA programs. These are the PLC and the ARC estimated prices for 2025. Of course, we are in that sign-up stage now that you can sign up for ARC and PLC at FSA. Randy, we're going ARC on everything this year?
Kind of looks that way when you look at where the prices are, compared to PLC. ARC does have a little bit more of a, it has the higher price advantage.
And yeah, just as a refresher there too, just using Cass County corn, they take the Olympic average times the price, and then they take it times the 86%. So for 2024, Cass County was a 173.56 times a 503 price. Knock that down to 86%, gets down to a 571. In the examples we were seeing, again, the yields aren't out there yet. We don't know what the county yields were, but if we assume like around a 180 and a 455 marketing your average price, that's going to be over that 751. So there's no payment on ARC. I don't think much is going to get paid. Nothing, I don't think, for corn and soybeans up here. For PLC, the reference price was 426, and the marketing year average price right now is estimated at 455. So no payment on the PLC side either. And so when you look at those numbers, you have to keep in mind too that we'll take that ARC number times the yield, and then we will take that 86% into account. And like I said, you can sign up right now. They did change the rules. ARC and PLC, you can sign up until April 15th. Crop insurance, though, our deadline is still March 15th for SCO, ECO. So we didn't get the extension that FSA did. And again, remember, if you sign up for SCO, you cannot have ARC on that crop or farm number. And we'll talk some more about that. I think we're kind of all getting a good handle on how SCO and ECO work. I want to look at some examples more than just reading slides. But again, SCO is going to start where your RP, YP, whatever coverage leaves off, up to 86%. Your guarantee is going to be based on your APH, but the loss is going to be based on a county yield. So it's not how your farm does, it's how the county does. And like I mentioned before, you cannot buy SCO if you have ARC at FSA. What you can do, though, is if you want to, test it out. We had some people last year they put a couple farms into PLC and left the rest in ARC. And that you can totally do as long as we know at acreage reporting time which land is ARC and which is PLC. And then we can sort through that and take it off the SCO coverage. If we don't do that and you had ARC, they will eventually check that, figure it out, and they will void your SCO coverage, and you will still have to pay 60% of the premium as a penalty. So if you take SCO, you want to make sure that we have you signed up appropriately at FSA and that we take it off anything we need to at acreage reporting time. ECO. This is the more intriguing one this year. Last year, ECO was really expensive because it's covering very shallow losses from 86 to 90% or 86 to 95. Same rules here. Coverage is based on your APH, but whether you have a loss, again, is based on the county yield. This one, because we're going above the 86%, we don't care what you do at FSA, ARC or PLC, it doesn't matter. You do not have to purchase SCO to cover it fully. You can leave that gap in there, and we'll go over that. So again, this is just kind of a picture. The blue is your MPCI coverage, your 75, 80, 85% coverage. And then your ARC or SCO picks up from where your MPCI leaves off up to 86%. And then the ECO would either go 86 to 90 or 86 to 95. And a reminder too on these area plans, the SCO and the ECO, for last year, we're not going to see those final county yields until May or June, depending on the crop. So unfortunately, you won't have a chance to see what the yields are before you have to sign up for the 2025 crop year on March 15th. This is a big change, though. This has kind of made me a fan of SCO. They increased the SCO subsidy. It was 44% last year, and now they raised it to 65%. So it is now the same subsidy as SCO. So it's made ECO a lot more reasonable. Okay, so here's a quote. Cass County, this is just a 100-acre enterprise unit. I used the 466 price from last year because that's where we're sitting right now, using a 180 yield. And you can see there, we have the RP at 70, 75, 80, and then the SCO and ECO coverage below that. So you see as the coverage levels go up on the RP, the SCO premiums go down because that gap is less. The gap from 70 to 86 is going to cost you more than the gap from 80 to 86. The ECO premium stays the exact same no matter what your RP coverage is, again, because that sits all on its own, either 86 to 90 or 86 to 95. And those premiums, honestly, they don't look too bad, all things considered. Like I said, this is corn. And this is soybeans here. And again, the ECO, 86 to 90, that 4% coverage, $20 of coverage for $2.72 in this case. So where do you fall to get a loss on this thing? So going back to the corn, if you took the ECO up to 95, you get, in this case, $75 of coverage for $13.60 an acre. If you wanted to take just the 4% one up to 90, $33 of coverage for $5.20 an acre. Again, this is just one example. For 2025, Cass County corn has an expected yield of 171.4. So I just started plugging in numbers to see, okay, let's leave the price the same. Just assume the price is 466 in the spring, 466 in the fall. Where do the yield have to fall to get the payouts? So if you do up to the 95%, the yield has to drop to a 162 to just start paying out. If it drops to 160, it'll cover your premium in this case. If it drops to 147, you pay out the entire $75. If you take the lesser chunk of that, just going up to 90%, a yield down to 154 would just start payments. Yield of 153 again would cover your premium. And again, because they both go to 86, it'll be the same as the 95%, where the 147 yield pays out the entire thing. And as a reminder to that, when you see that 147 yield, that's where SCO is just going to start paying out. So because the subsidy has been increased on this, I think it is more intriguing. I think skip the SCO, take ARC at FSA, and seriously look at the ECO, because you're getting really shallow loss coverage there. Anything else you want to add to that, Randy?
No, I think that makes perfect sense here. No matter where your multi-peril side line lies, it looks like the ECO is going to be a little bit better product this year because of the bigger subsidy and like you said, the shallow losses. Now we don't know where yields will fall into play, but this one does look like it might be able to generate a little bit of a claim situation anyway. Whereas right now, SCO is going to be tough to get down low enough to be able for that to trigger.
And again, this is assuming no price change. If the price in this example drops from 466 to $4, then those yields can be higher and the losses will still kick in. Again, looking at the soybeans, cheaper premiums here, not as much coverage, but same idea. Cass County this year has an county expected yield of 40.2. And so if you do the ECO up to 95, $43 of coverage for $7.27 an acre. The yield only has to drop to 38 to have it start paying out. It drops half a bushel more and it covers your premium. And then at 34.5, it pays out the entire $43. On the 90% ECO, we'd have to have the yield drop to 36 before the premiums would start kicking in. I've showed this before. We do have this spreadsheet where then we could just start putting in numbers. If you think the price is going to drop 10 cents or 50 cents or whatever, we could put that in with some different yields so you get a good feel of when the payments will kick in. And like I said, I can send that to you or we can work through it together. So do some examples for you. Which leads me to my last comment tonight. If you haven't sent your production in, please do so as soon as you can. Once we get rolling in late February, we are spending all of our time quoting. So we'd love to have the production before that. Without your production, we can't calculate a personal T yield. We can't calculate what your simple average will be if you pick up a new piece of land. Even the things like TA and QL, we can't tell you exactly how much it'll help your APH, whether it's worth the cost. TA, for example, sometimes on soybeans, it's just not worth it. The little bump you get in yield isn't worth the premium. We can't figure out any of that stuff if we don't have your production. We do have your production. We can start doing preliminary quotes. We can start looking at SCO, ECO scenarios now. We don't have to wait. Of course, the prices aren't established yet, but we can get just a rough estimate of stuff that's going on. So if there's specific things you want to see sooner than later, just call our office, send me an email, and we can work up whatever you need. And that is all I have. Anything else you want to add to that, Randy?
No, I mean, I think you kind of nailed it there. Yeah, it's kind of nice to be able to get, trying to get the production in, get the right quotes out, and kind of have a little better idea of what's going to happen as far as where prices are going to be. Right now, that's kind of another big toss up. I would expect that, corn will fall somewhere in the area where we were last year, with minor changes. As far as, soybeans, we are going to be lower. And right now, wheat is actually, surprisingly enough, trying to participate in this a little bit of a run. So that price for wheat could be a little bit close to last year. So, I mean, we're going to have maybe a little bit lower guarantees than last year, but it's not going to be much different at this point.
We had a couple questions in the chat. One was, when will they get corn separated grain and silage? I assume for an enterprise unit. I don't know. I don't know if the corn growers are pushing for that. I would love to see enterprise by type between corn and silage. I do not know if that's on the horizon, though. The other question was, are you pushing producers towards ECO on corn? Kind of looks like a toss-up. Randy, you want to take that one?
Well, yeah. I mean, you have to look at it pretty close right now. I mean, it might not pay to go to the 95 and spend that extra $13.60, but it might look at, to do the up to 90%. Depends on where the multi-peril falls and whether you're doing with the enterprise units. It does look like, when we were running some of the quotes early, that does look like even the enterprise, for 75 is going to be fairly reasonable again, but you got to look at your budget, what you have allocated in there. And right now it does look like I would consider doing up to 90. I don't know if I would do the 95 for corn.
And again, I just did these two examples quick. There's many more crops out there that we can do SCO and ECO on. Again, if you're interested in, canola or wheat or whatever, shoot me an email and I can send you some preliminary quotes for that. With that, I will turn this over to Randy.
Okay.
Can you see that?
I can see it.
Okay.
And I even got control, so again, I apologize for not being able to be on the camera. That is for everybody else's benefit to not have to stare at me. So no, I'm having difficulties with my computer and not being able to access my camera. So again, now looking at where we're at, I mean, the last few weeks have been kind of interesting as far as the marketplace is concerned. And really it's been three things that have been kind of driving this market. Tariff concerns, weather, and demand. I mean, that's been kind of the big ones that we've been watching here. Weather, not just in the U.S., but primarily in South America, but also in Russia has been lately making a little bit more of the news. And of course, the tariff talk with the idea that we have that threat over our heads. Now, again, like I mentioned when we started here, I've been very impressed with how the market's behaving here tonight. Minneapolis wheat has come out of nowhere and really started to participate and actually leading the grains here again tonight. It's up about 2 to 3 cents. Chicago and Kansas City are down a couple cents. Corn continues to be down about 4 cents, and that is, again, because of the tariff potential there with Canada and with Mexico. But soybeans have actually pushed higher. Soybeans right now are trading with 1 to 1.5 cent gains, primarily due to the fact that soybean meal is leading this market. And they've been kind of the leader pulling soybeans higher here this week. And soybean meal is up about $5 to $6 tonight. So, and I'll talk a little bit more about why soybeans are, when the meal is leading it when we get to that. But looking at, for some reason now I can't advance it because there we go. Of course, we have to say that there's risk involved. This is kind of our NFA saying that we have to put this disclaimer out there. And since this is being recorded, we really have to put it out there. So there is risk, and past performance is not indicative. So I'd like to throw this out, just kind of more of a conversation piece more than anything. You look at what the last year has brought us as far as commodities are concerned. It's made our breakfast a lot more expensive. When you look at it, the markets that have led as far as gains so far this week have been coffee, whether it be the two different varieties that are out there that are traded. Orange juice has been one of the other big ones that have been gained quite a bit of ground over the last year because of the weather concerns in Florida. Lean hogs, our bacon's gotten a little bit more expensive, up about 20%. Of course, everybody knows about eggs because of the prices that we've been seeing increase in those. But then everything else kind of got a little bit cheaper. When you look at it with the crude oil, it was virtually unchanged. But we did see the grains lose quite a bit of ground this year. Chicago wheat was down close to 12%, 13% in Kansas City. Soybean oil took a little bit of a hit, down 16%, and that's at a time when we've been relying more on the biofuels industry. Spring wheat was down close to 18%. Soybean meal was down close to 18%, and then of course soybeans down 22%. Where's corn fall into this play? I'm trying to find. Corn was only down about 3%, so not as bad with corn. And actually, corn has been one of the leaders here as of late. Now, when we look at the markets, one of the things we saw in the January numbers was that came out was where our principal acres are falling. That's basically the acres that get planted to the biggest crops. And you can see those listed right there as for the main crops that are raised across the U.S. Interesting to see that North Dakota continues to be in the top, 1, 2, 3 of principal crop acres as far as a state in the U.S. But when you look at it this year, what was interesting is, we dropped from 319 last year to 311 this year. 4 million of that went into prevent plant. So where the other 4 million acre decrease came is kind of interesting to see. I mean, there's no explanation for it. Some of it could be CRP. Some of it, of course, is urban sprawl, but the fact that we did not lose that many on the harvested acre side tells us that we did lose wasn't very productive land, as we're still harvesting more than or almost close to what we did here the previous year. And when you look at the states that saw the decrease, all of them in red saw decreases in principal crop acres. And it was just about every one of the states other than, a handful of ones, spread across, especially more into the western region. So just about every state saw a little bit of a decrease over this last year. Now, looking at wheat, as I said, I've been actually impressed with wheat the last couple of days. Before, I did a presentation on Tuesday and I did one on Wednesday. And the theme there was that, wheat is buying time and waiting for something to happen. Well, that something started happening here as of late. And a lot of it was being tied to what's going on with Russia. Russia right now, their weather agency, the National Weather Agency, put out a report saying that 38% of their winter crops are poor to very poor. And of course, in true fashion, their ag minister, the government side of things, came out and said, no, we're actually seeing our crop at 82% good to excellent. So a little conflicting news there, but they lowered their exportable bushels for wheat for the year, and they've cut down or they put in quotas, stringent quotas for the next 6 months to try to slow down the exporting of grain. So that's kind of what's come in and help support the wheat. Also, as far as the Southern Plains are concerned, we're seeing the rain that was forecasted to fall in the western regions of the winter wheat region are now moving to the east, and we're not seeing much rain fall as far as the main winter wheat growing regions of Kansas and Oklahoma. Looking as far as what the wheat numbers for the January report, it was nothing. I mean, they didn't really change much of anything. We did see imports increased, and this is the part where I've been telling guys where tariffs against Canada, I think, are not going to be a bad thing because we import roughly 130 million bushels of wheat into the U.S. A majority of them, well, all of it is virtually spring wheat and durum, which impacts the northern plains more than anything. Well, if we and it comes from Canada. So if we put tariffs on and we slow down that flow of wheat, that's certainly going to help use our domestic supply. So putting a tariff against Canada, I think, could help our wheat market. And that's probably part of the reason why Minneapolis is stronger tonight. The winter wheats are a little bit weaker, but that will help a little bit. Also, one of the bad things, of course, is that they buy a lot of our corn. We buy a lot of their fertilizer. We buy a lot of their crude oil. So there's going to be it's going to be interesting to see how this moves over the next few days once it becomes a little bit more known. For winter wheat acres, what surprised everybody is that we saw a large increase in winter wheat acres. And when you look at it, the pie chart there, you can see that it wasn't the winter wheat areas that saw the biggest increase, which are where most of the winter wheat is raised. It came in the other category, which falls into either the white wheat or the soft red wheat. That's where the biggest share of the acres came from, was in those two areas. The winter wheat acres did see a pretty good drop all the way down to 2020, which we were actually looking at the, I think, 40-year lows as far as wheat acres were concerned, and we've slowly started to build those acres since then. Harvested acres have seen a little bit of an improvement as well because of better conditions. When you look at where the winter wheat acres, this is what I mean by where the acres were planted, you can see that where the blue is where the increase came, where the red came is where we saw decreases. And most of the decreases were in the hard red winter wheat areas, with looking at even Kansas dropping by about 2.6%, almost 3% from the previous year. But where we're seeing it is out in the soft red area, all the way into Ohio, Indiana, Illinois, Wisconsin, and then into the Delta areas. And this is, I think, what it's kind of telling us is that producers out in those areas are looking for something other than corn to raise, and they're looking at planting wheat and double cropping it with soybeans. So very likely we're going to see a pretty large increase of double cropping in those areas. Now, we did see a big increase in hard red winter wheat acres in in Texas and in Montana, mainly because they had moisture and they had an opportunity to plant a little bit more acreage. Now, when you look at it, this is busy, but it basically breaks down where the acres came into play, where the changes came. Kansas dropped their acres by about 188,000. We increased Montana by 297,000 and Texas by 285,000. So when you look at it, you can see those are the big changes for the hard red winter wheat areas. And we also did see, when you look at the soft red, that's the kind of the next column over, we saw Ohio increase by 140,000, and we did see Michigan increase by 98. So we're looking at other areas that are looking at raising the winter wheat. Now, what's interesting about those two areas is the soft red, and that's where a lot of this cold, wintry weather came 2 weeks ago. And they're estimating that about 15% of that winter wheat got hurt by that cold snap that came into play. And that, I think, helped to add a little bit of support into the market here as of late as well. Winter wheat conditions, when it went into dormancy, were fantastic, the best we've seen in 20 years. Those conditions have declined. You can actually see by the end of December that we did see most of the states. Colorado improved a little bit, but Illinois was down. Kansas dropped. We saw Montana increase a little bit with the rains and the snows that they picked up. Nebraska was down hard, as was North Carolina. Oklahoma saw a little bit of a decrease. So the crop went a little bit backwards here in the month of December. Now, I believe it's going to be either tomorrow or it'll be Monday when we actually will see the January numbers, and it'll give us another update as far as where the wheat conditions are. But winter conditions are not indicative of how the crop's going to come out in dormancy in the spring, but it gives us an idea of just where this crop is sitting at and what kind of conditions it. And if we continue to see it deteriorate, that of course is going to raise a few red flags going forward. But here's what I mean, where wheat hasn't been that stellar of a market or that impressive, and we've just kind of been hovering down at our lows, mainly because when you look at the 24-25 supply and demand numbers, our stocks are sitting at 798, compared, quite a bit higher than where we were last year, almost 100 million. And then it looks like we're going to see another increase. Now, we are USDA, the outside numbers are USDA's Outlook Farm numbers, and they're expecting we're going to have 46 million acres of wheat. That tells us that we're only looking at, if we've got 750,000 more winter wheat acres planted, we're going to have to see lower spring wheat acres. And I do think we will see a decrease in spring wheat acres by close to 1 million when we go into next year, unless this market really starts to rally and try to gain a little bit more attention on the acre side. But we are seeing the stocks increase for wheat up to 814 for this next year, which is going to take or limit any kind of a move that market can make. Now, there are a few things that are positive as far as the wheat market is concerned. And one of them is demand. I mean, our exports for 23, 24 were down to 40, 45-year lows. And now we've seen them rebound quite a bit. Actually, we added 150 million bushels onto our exports, which is something that we needed to see happen. That's the one thing that has been missing in wheat for the last few years, and that mainly because of Russia coming in and basically dumping the wheat on the market because they've had such strong production. They had to sell it, and they were the market in town. They kind of wanted to capture the export market. And you can see last year's, the 23-24 is just barely a green dot down over there, way over to the right. And this goes back all the way to 72. That was the lowest exports by far since we've seen since 1972. The previous one was in 2015. Now we've seen, like I said, a nice recovery. We're not back to what we would call average as far as exports are concerned for wheat, but we are slowly starting to get a little bit of demand coming back our direction. A lot of it is in the Pacific Rim and in the Philippines and those areas. We haven't really broke into any place big, but it was interesting that we did sell some spring wheat to Egypt for the first time in, I believe, 20 years this last year. So that was a little bit encouraging that we are starting to get into some of the markets we haven't been at for a long, long time. When you look at the wheat export shipments, we're right in the middle of the pace. And it does look like at this point we should be able to make USDA's projections. If I was a betting man right now, I would say we will be able to, basically get, what USDA's projected. Sales have turned down a little, it's been kind of waffling back and forth. We're at the bottom end of the range, but if a few things come in play, and that is if Russia backs away from things a little bit more, we do have the potential to see our exports for wheat increase a little bit in the last third of the marketing year. Now, the other interesting thing is that India is on the threshold of having to import wheat. India is a very large producer of wheat. They're a very large consumer of wheat. They are having some problems in country with the price of wheat. It's going too high. So they've been bringing wheat out of their reserves and dumping it onto their market. It hasn't worked. It's not bringing the price down, and it's causing a little bit of concern with the people of India or the government, because they're thinking the people could start to look at overthrowing because, a lot of people getting hungry in that country. So they have now removed the tariff on imports for wheat, which tells us that they're getting ready to start importing a little bit of wheat. Now, the likelihood that they're going to import wheat from the U.S. is virtually zero, but they are going to take it off the market. They're going to take it from either Ukraine or from Russia, and that will deplete their stocks even further, which will allow the U.S. to participate in some of our more friendlier countries. Wheat stocks, we had a nice decline as far as the U.S. is going, mainly because we were decreasing acres. Bottomed out here in about 22, and now we've started to see our stock starting to just slowly increase, which has kind of dampened the ability for wheat to see much of a rally in the short term. Now, here's what I was talking about when you look at as far as the world is concerned. When you look at world production, the largest producer of wheat in the world is China. Number 2 comes in as the European Union. Number 3 comes in as India, and then Russia, and then that's followed by the U.S. So that's the 5 largest producers of wheat in the world. When you look at who actually is the ones who are exporting it, China does not export wheat. India exports very little wheat, only if they have excess, and they actually import a little bit more. And then when you look at it as far as Russia, that's where the biggest exports come into play, and they're the ones that kind of command it. You can see that how we compare in there as far as the export side of things. European Union isn't even that big of an exporter because most of that is used within their 26 countries. So they're not really a big player when it looks like for the rest of the world on the export side of things. And when you look at who's holding the stocks, it's all being held in China. And you can see that their stocks have slowly been decreasing, as is most of the rest of the countries, except, the U.S. is seeing a little bit of a stocks increase this year. When you're looking at a world standpoint, excluding China, right now we have the tightest wheat stocks in the last 4 years. In the last 4 years, we've seen them continually get a little bit tighter. And that is the one thing that could help support the wheat, is that stocks are tight And we've got some countries that are starting to see a little bit of issues as far as production is concerned and needing to have some supplies funneled into some of the largest consuming countries in the world. That's the one thing that could help to push the wheat market. What I found to be interesting, though, when I also in that January report, we also do what's called the quarterly grain stocks report. It gives us an idea of how much grain is in our bin as of that time frame. And as of December 1st, we were sitting with about 1.5 billion bushels of wheat in storage. The odd part is that 1/3 of it is on farm, 2/3 of it is off farm, and that could likely cause a little bit of trouble with or kind of stifle the ability for wheat to see a pretty big rally at this point. Now, we've seen a nice rally recently. Basis levels have gotten a little bit wider. Some of the scales have improved because they needed to get some protein wheat out and to help blend with our poorer crop that we had last year. I think the scales and the protein premiums will continue to stay strong, but it's not likely we're going to see basis improve until we get a little bit deeper into the spring timeframe. And when you look at the charts, this is the March Minneapolis wheat, and it's building a very strong base. I mean, that where we see this market from basically mid-November to recently, we've had some movement, but it hasn't been tremendous movement. That's what we call base building, and hopefully that's going to create a very strong support line as far as wheat is concerned. And now we're starting to finally break out of that a little bit here now the last few days and starting to make a pretty decent run for it. My line in the sand to look at starting selling wheat again is at that 635 area, which I thought was kind of a pipe dream here 2 days ago. But right now, sitting at that 620, 623 here, we actually have a solid shot at testing that level here in the very short term. So for corn, there's not many times that we can say USDA is friendly to a market, but when we can say it actually for 2 months in a row, that's really an anomaly. Looking at what USDA did, they came in, and this is actually the December report. They came in and they cut or increased demand by about 200 million bushels, cutting our ending stocks estimate by the 200 million. That virtually took our ending stocks estimate from a 1.7 or from a 1.9 down to a 1.7 billion bushels, which was less than what we saw the previous year. Looking at these numbers that we saw from the December report basically told us that corn was undervalued for what the numbers are telling us, what the fundamentals are telling us, so that this market needed to see a little bit of a correction. It took it a little while, but we've started to see a little bit of a climbing out of that. Well, then in the January report, they solidified the fact that they wanted to be friendly corn by lowering the yield by 3.8 bushels. I mean, that was the largest decrease ever that we saw going into the last report from USDA for supply and demand numbers for the grains. Took us down. I mean, it lowered our yield quite a bit, but still a record yield, but it trimmed it quite a bit from where we were expecting to be at. And it took our production down below 15 billion bushels. Well, now that was the second month in a row that we saw a 200 million bushel decrease as far as our stocks were concerned, putting stocks now at 1.5 billion. In May of 2024, when USDA comes with their first supply and demand estimates, their actual real numbers that they look at for where the supply and demand numbers could be at for the year, with where production and where the demand side is going to come into fall into play, they had an ending stocks for corn at 2.5 billion. So we're looking at 1 billion less bushels of corn than what USDA thought we were going to have at the start of the year. And a lot of that is due to the increase in exports, and some of that is due to the increase in the feed demand and also ethanol. So good demand sources coming in and helping to push that market. And again, the way it looks, corn is still a little bit undervalued from where it should be at when you look at where the fundamental numbers are coming into play. When you look at production, we did see, like I said, acres were down just because they cut our acres a little bit. Our yield was up from the previous year, but down quite a bit from the previous month. Looking at the states, pretty much most of the big states did see production increases, mainly because yields increased. But we did see Minnesota and Indiana see a little bit of a drop. The debate that's starting to come into play, mainly because of the drop in the yield, and the fact that we have not hit trendline yield for the last 3 years, the debate is, can we hit trendline yield? Trendline yield basically is taking the yield for over 30 years and adding them up and dividing. And that tells us that year over year, the yield for corn improves by about 2 bushels every year. That's kind of what trend tells us. So trend this year was right around that 180 area, 181. So that was a couple bushels higher than last year. Well, right now the debate is that, can we get to trendline yield anymore? Mainly because the corn acres aren't really coming from the Corn Belt anymore. It's coming from the fringe areas or the fringe states. And when you look at where the yields came into play, the red shows where yields decreased this last year for corn. The blue is where things increased. Now, you look at North Dakota and South Dakota, if it wouldn't have been for a very good September and October, we likely would not have seen higher yield numbers for our 2 states. But when you look at out in the eastern seaboard and even into the eastern part of the Corn Belt, all those yields were a little bit lower, mainly because of the hurricane that came through and some adverse weather. But it kind of builds into the expectation or the thought that no matter, it's just going to be hard to be able to get to those trend line yields because of more of the corn acres being shifted out to the fringe areas where the yields aren't going to be as strong as what you're going to see in the major states. Corn production, as I said, really good. It still was good. I mean, it still came in just shy of the 15 billion, and then what was it, the 4th largest that we've seen in history. So a good number nonetheless. When you look at it, I mean, we had 90 million planted. We came in with our stocks estimate of 1.5 billion. USDA is expecting, the Ag Outlook Forum is looking at 2 million more acres of corn being added this next year. I'd say that right now I would agree with that number. I don't think we're going to see anything more than that. But what's interesting is that our stocks are only going to build to about a 1.8, and that is even with a little bit lower demand structure from USDA. They're looking for exports to drop off a little bit. Actually, all of our demand, other than feed demand, they expect that to increase a little bit, but the others are to see a little decrease. So they are looking at not a big change as far as the corn is concerned for our ending stocks, which should help stabilize prices going forward a little bit. I'm not looking for any major sell-off in corn, or at least if there is a sell-off, it's going to be something that won't be sustainable. We'll have to see a little bit of a recovery again. When you look at the demand sources as far as corn is concerned, the biggest, of course, are feed and ethanol. We don't see ethanol pulling back here right now. It's going to be interesting to see what Congress does. There is a little bit of a debate going on right now because of some of the congressmen aren't as friendly to renewable fuels. And there is a bill that has been put in by a Texas congresswoman to do away with the 45Z. Now, the 45Z was the Biden administration's version of the subsidies that were given to the biofuels industry for blending, for producing. And they're looking at doing away with that. If that follows through, that would be a severe hit as far as, ethanol, biodiesel, renewable diesel, and sustainable aviation fuel is concerned. But I don't think it's something that we can say, break away from, but it is something that is going to be tested in Congress once again. Also, the new EPA director is also not a fan of the renewable side of things. But when you look at where ethanol production's been up until this last week, this actually came out today, and we saw a huge drop in ethanol production. For the most part, we've been running at the top end of the last 5 years, so it's been a pretty good production. But like I said, this last week, we did see a pretty good drop. Exports for corn have been what's been stellar, and we've been seeing a strong increase. We're actually at the top of the 5-year average for corn exports, and it looks like that is kind of still trending up a little bit. We'll see what happens with these tariffs that come into play with Mexico in the short term. When you look at sales, you can see a couple of blips that we saw come into play where we saw more corn demand come into play. Just recently that we saw the last couple of weeks, why we saw our corn exports increase, the sales, is because of the concerns that are going on in Argentina and Brazil. Argentina, of course, is seeing very hot, dry conditions, and that's helping to support both the corn and the soybeans. It does look like that crop is going to continue. Those crops are going to continue to decrease with production estimates because of the next 7 to 10 days. Actually, it looks like it could be all the way out to 15 days of hot and dry conditions, and they're looking at 95 to 100 degree temperatures. But we're also seeing, to add into that, Brazil is been getting rain, especially in the center, the north central and the center part of this country, where they're trying to combine the soybeans. If they can't get the soybeans combined, that means they can't plant the second safrinha corn crop, and that has caused a little bit of concerns about potential exports for corn later in the year, and that's why we started to see a little bit of a bump up in corn exports in the U.S. To Mexico, we've been thinking they're kind of front loading ahead of the tariffs coming into play, but they are actually at the top of their 3-year average for exports right now. So that's been encouraging. And again, like I said, with this coming into play, this news here tonight, we'll see where that number comes into play. As I mentioned, when you look at the ending stocks estimate and where price is at, it just shows that, maybe that corn price is just a little bit undervalued from where it should be. I would expect that we should see a little bit more strength in this. We've been waiting for that 495 level to get triggered. We got triggered yesterday. Should have made a little bit of sales there. Now the next level is up in that 515 area. So we'll see if we can break above that. I think we could stall out here short term, just as we try to sort through whether or not Mexico is going to cave quick or not. Now, the other interesting thing about our exports that I should mention, the number 3 buyer of corn in the U.S. right now is Colombia. That came out of nowhere. It was kind of something we didn't expect, that Colombia would be buying a lot of corn from the U.S., but they're the 3rd largest buyer. And we did run into a little bit of trouble with them, of course, as we're trying to send the immigrants back actually sending some back to Colombia, whereas the Colombian president refused to allow the planes to come in and land. Well, within an hour, he was threatened, of course, with 25% tariffs, with the increasing another 25% within the next week. And they came with a compromise that they have now sent their planes up here and are taking their immigrants back to their country. So it did not take long for Colombia to cave under the will of the administration and kind of come to terms. Now we'll see if 70% of what Mexico imports comes from the U.S., whether it be chicken, whether it be corn, whether it be wheat, whether it be whatever it is. I mean, they buy a lot of products from the U.S. Edible beans is a big one. So I don't think that any kind of tariffs or any kind of issues will last long with Mexico. Canada, on the other side, we only ship about 30% of their needs to them. They might be able to last a little bit longer. We actually bring in more from them than what we ship to them. So that one might take a little bit longer to get that one settled. The biggest trouble is that the tariffs against them, if they retaliate against us, Canada could come back and put it on fertilizer and on crude oil. The idea in Trump's statement, he did say that they might exclude oil or crude oil from being part of the tariff, and that will certainly help on the energy side, but it won't help on our fertilizer side. So now looking at it for corn stocks, right now what's interesting is that 2/3 are being held on farm, 1/3 is being held actually off farm and other in the commercial's hands. So that was kind of interesting. And that is to the fact that, that's where the ethanol plants and the corn sweetener plants are holding a lot less tighter supplies, which means that if there gets to be some inclement weather, they're going to be pretty aggressive to try to get product. When you look at the corn chart, like I said, corn has been the stellar. That's been the one that everybody's been watching. It's been the one that's had the best support, had some good strength. We're close to almost 90 cents off of our lows. And like I said, we still have a chance to be able to get up and flirt with testing the little higher levels if we can continue to see trouble in South America with as far as weather is concerned, and a little less knee-jerk reaction to what's going on as far as the tariffs are concerned. Going over to soybeans. Soybeans aren't as friendly, and right now, everybody's worried about the tariff side on those, and I'm just not too worried because where we're putting the tariffs aren't on anybody who's really looking at buying soybeans from the U.S. in the short term. Our exports have slowed down. Right now the demand that we've got as far as soybeans are concerned are going to be within our crush plants within the U.S. because as harvest gets advancing in Brazil, they're going to be supplying most of the countries with their needs. The report was friendly. I can't say that it was bullish in January for soybeans because it's hard to say 380 million bushel ending stocks estimate is bullish for soybeans. But it did tighten it by 90 million, and it did certainly bring a little bit of good news to us. And it is helping to maybe prepare us for maybe a little bit better numbers for next year. Everybody had a little bit better production as far as soybeans were concerned, other than Minnesota, mainly because of, like we saw up in North Dakota, a hot September, which took the top end off of the soybean crop in Minnesota. So that's kind of what we were seeing there. The rest of the region actually did come in pretty good as far as production is concerned. But, excuse me, just like corn, soybeans did not, for the third year in a row, were not able to get to trendline yield. And the same argument's kind of playing out there, is that can we get to trendline yield with most of the soybeans coming in some of these fringe areas? You look at where most of the decreases came into play. Most of it was where the hurricanes hit and caused a little bit of flooding, a little bit of concerns. We did see a little bit better on the outskirts of the eastern seaboard. North Dakota was a little bit better. I mean, we did see it trimmed, but it did come in a little bit higher than the previous year by about 5%. But Minnesota was down a little bit, and South Dakota was down a little bit. Tells me that if maybe that September, it hurt us a little bit, but it also helped to be able to get a lot of the beans to maturity. And like corn, it wasn't a record crop, but it was a good crop. It's one of the, up there in the top 5 or 6. When you look at numbers for the ending stocks and basically the supply and demand numbers, as I said, we've got a 380 million bushels ending stocks estimate. Next year, we look at cutting about 2 million. That's the acres that are expected to go switch over to corn. Still only brings our ending stocks estimate down to about 345. So we're not seeing anything get extremely tight as far as soybeans are concerned. It's friendly, but it's not a bullish number. We need to get down into the 200s to see it get to be a little bit more bullish. And we need to see that our stocks to use ratio, that 7.7, needs to get down to a 6 or below 6 before we start to see the soybean market get excited. It doesn't mean that we can't see some strength coming forward, but it's going to be muted strength and it won't be long lasting. I don't feel in the soybean market if we can start seeing a little bit of a push. As far as the U.S., production's been climbing. I mean, since 1965, when we barely produced, we was under 1 million bushels. Now we're up to almost 4.5 million. So tremendous increase, a lot of interest in that crop that has really helped to push its production quite nicely over the last few years. When you look at the demand, what's really been interesting here is that what we've been seeing as far as the crush side of things. Crush has seen a huge increase since 2015, whereas exports have been all over the board. You can see, when China had the trouble with their hogs, we saw the demand drop. The phase 1 deal, we saw them shoot sharply back up again where they were buying from us. And then it's just slowly gone down. And now we're starting to see a little bit of a recovery in the soybean exports. And not so much because of China. China has stepped away from the market. They're only getting about 20 to 30% of their needs out of the U.S. at this point. And I don't see that number changing. Most of it is coming out of Brazil. But what we've been doing is seeing a lot of new customers start to come to town to buy our beans. And when you can look and just see where our exports have been at over the last, just take the last 7, 8, 9, 10 years here, you can see that we've had some pretty strong years. As I mentioned, we dropped down because of China and their pig herd reduction. And then we've just slowly seen it since the phase 1 trade deal slowly start to erode and lose a little bit of that. Hopefully we can get it back again, or we need to find another demand source. And that's where that renewable fuels, the biofuel side, has really been coming in nice to help kind of bridge the gap of what we've lost on the export side of things. Exports are right in the middle of the range right now. Nothing fantastic. I mean, you look at it, we should be able to make USDA's projections, but it's going to be tight to be able to get there. Sales saw a little bit of an upturn, same scenario as we played out in corn. the fact that South America is having some production problems or potential problems, we've seen demand come back into the U.S., which has helped kind of turn our exports up a little bit for soybeans. But when you look at it for China, China's still the largest buyer of U.S. soybeans right now. They're still buying more than anybody else, but they're at the bottom end of their 3-year average, and it doesn't. They saw a little bit of an uptick here. Again, that's mainly because of the trouble in South America. Whether or not they're going to get any better, it's highly doubtful, especially since we're looking at Brazil getting more into their harvest here right now. Crush has been what's really been kind of helping to hold the market together. The gray bars that you see are the record crush numbers for each of the months. The black is where we were for 22 and 23. Blue is where we were in 23, and you can see a lot of them now were at record crush numbers. And you can see the last 3 in the U.S. have been, excuse the pun, but the crush has been crushing it. We've been seeing a tremendously larger than expected crush over the last couple of months. And that's kind of the direction where a lot of our soybeans have been going. And our soybean oil stocks have been at some of the tightest that they've seen at. And that's because the demand is there, not just, domestically, but we've also been seeing a small number of beans go to soybean oil to the export. And the meal side, that's what everybody keeps asking is, can the meal exports continue to keep up? And so far we've been able to keep up on the soybean meal exports, mainly because of, again, the Pacific Rim regions that have been buying quite a bit of our meal. But now, because of the trouble that we're seeing in Argentina, we're seeing another increase in U.S. Soybean meal demand. For stocks, basically soybean stocks are sitting 50-50 right now. Half is on the farm, half is off the farm, which, that kind of stands to reason that can be somewhat understandable. Now, I just want to take a look at what we've seen as far as, like I talked about, the renewable side of things, the biofuels. The orange bar at the top is where our food demand has been at for soybean oil, and it's been pretty constant. The blue line is where the biofuel side has been at. And like I said, since 15, that's been a sharp increase. And it's actually above food and feed and industry right now. Our exports have dropped off hard, and we also almost went to 0 in 22, but it's been slowly seeing a little bit of an increase since then. And here's kind of another, just a better look at where our exports and our imports have fallen for soybean oil. We used to be a very large exporter of soybean oil. But in 22, when we started building these plants and starting doing the renewable diesel fuel, we've been keeping a lot more of our soybean oil at home and using it ourselves to make product. And it looks like over time, we're going to see the exports start to build again. But right now, as far as our import and our exports, it's very small for the soybean oil industry. World soybean demand or production has increased. That's mainly due to the increase with Brazil. And it, from back in, this goes all the way back to 1905, where we barely had any acres, up to where we are right now. So the production has been a steady incline for soybeans. And a lot of that is due to a lot better protein sources for other countries and the demand for soybean oil. When you look at production, the blue line is where Brazil is right now. U.S. is the green line, and Argentina comes in as the red. Argentina doesn't fluctuate much. Weather is the only thing that really can influence them, whether they're going to have a good crop or a bad crop. They're not looking at adding any acres. Brazil, on the other hand, is adding acres, and you can see again, this goes back to 2000, how much they've increased their production in just 24 years, overtaking the U.S. actually in 2012, kind of running parallel at that point, but then really taking over from us about 18. And when you look at exports, again, in about 2011 is when Brazil started to export a lot more than we were. We run parallel, but over the last few years, we've kind of gone opposite directions of each other as far as the export market is concerned. But Argentina, again, has not exported a lot of beans. They are not our competitor when you look at whole soybean exports. They basically export soybean meal and soybean oil, not so much the whole beans. So it's really, when you look at where the exports are going to come from for the whole bean, it's going to come from the U.S. or it's going to come from Brazil. And when you look at it, just to give you a perspective of what I saw this chart from Susan Noble, and I had to put it on this tweet, and I put it in here. You can see Brazil's production is quite a bit bigger than ours, but Mato Grosso, and that's the area right now that is seeing the rain and seeing the harvest delays. Just that region, it's about 29% of the beans that are raised in Brazil, but their production is equal to Illinois, Iowa, and Indiana combined. So you can see how important the Mato Grosso region is as far as production is concerned for Brazil. And then when you look at what's going on, with Brazil, the last couple of meetings I did, I'd been asked this question: just how much can Brazil bring into production right now? They've kind of backed off. I mean, every year they've been looking at increasing their acres by about anywhere from 3 to 5%. This last year they only increased it by about 2% because of farm financial issues, just like what we were seeing. But in the big picture, they have their pasture that it's available to bring into agriculture, and that's about 490 million acres that is left that can be accessed and brought into cultivation. Now, it's likely not all of those acres will get there. It's not likely that that country can, their infrastructure can even handle increasing their acres that much, but it does show that they have the capabilities. If things were starting to improve on infrastructure and logistics, they have the capabilities of adding a lot more acres to their agricultural base, which right now I would expect that they could double their acres. I don't know if they could do any more than doubling it at this point. So, and when you look at the soybean chart, that's kind of where we're at. I mean, it's a nice increase, a nice recovery. Hasn't been as impressive as what we saw in corn, but I'm still waiting to get up to that 1085 level to be able to make some sales in soybeans, and that's kind of where I'm kind of looking for that market to go to. So I think with that, I'm done. If there's questions, raise your hand. Well, no, put them in the chat and we can answer questions, or if Amy comes back on, maybe we'll know what we're doing.
Nothing in the chat.
Okay, well, they're done. We're done.
Thanks for joining us tonight. You guys know how to contact us. Give us a call if you have any questions. Thanks for attending.